All right, welcome to another edition of Major Money Matters. Hey guys, on this edition of Major Money Matters, we are going to talk about your loan estimate or the various different ways that your lender or a lender may present information to you, and you're going to have to really dissect that information and figure out, the right questions to ask, the fees you're being charged, and how inevitably your money is being allocated. And sometimes this can be very confusing. So I'm going to do this in multiple different ways. People might want to watch this video if you're comparing loan estimates from two different lenders. And then at the end of this video, we're going to talk about, are the numbers really all that matter? And I'll give you my perspective on that and give you some understanding about how this works in the lending industry. So, all right, first thing we're going to talk about today is fee sheets. Okay, so I'm going to show you an example of a couple of fee sheets and how this information may be presented to you, just to show you some things to look for and really answer the question of, is this actually really relevant? So let's take a look at this fee sheet. And actually, this is a fee sheet that I actually gave to a client. And this is an itemized fee sheet, and yours might look something like this. But keep in mind, a fee sheet is not exactly toilet paper, but it's one step above toilet paper. This is just to give you general estimates. You should not put your faith in the interest rate that's quoted on a fee sheet generally, because interest rates change daily, often multiple times within a day. So this is just to give you a general idea about what the fees are going to look like when you're purchasing the property. So you can see here like general fees, like what your appraisal fee is going to be. This right here is a fee sheet for an FHA loan. So it's talking about the upfront mortgage insurance here. It's going to talk about services you can shop for, services you can't shop for, which that in and of itself is a misleading terminology. Can you really shop for it? Yes, but you can't shop for it independently. Really, you choose a title company, or the seller chooses a title company. And by you choosing that title company, you're basically choosing the fees that come with that title company. So can you shop for it? Sure. But you're shopping for it by selecting a different title company. And depending on the state you're in, I'll tell you honestly, the fees are generally the same from title company to title company. Texas, the fees are very heavily regulated from title company to title company. So you're not going to get, that much of savings. Generally, you're looking for service when you change title companies or something like that. It's going to talk about your estimated cash to close. Now, this may be formatted in multiple different ways, because I will show you a fee sheet from a builder that a client sent to me. Okay, this fee sheet is a fee sheet that a client or potential client sent to me. This is an offer that they were being given by a builder. And they were asking my input and my recommendation on it. So I want to share this with you just so you can see, generally, this may be laid out in different formats. There's no standardization to a fee sheet. It could be generally an Excel document. I've seen those before, but it's just to give you a general idea about fees. Okay, so maybe a general idea about, what your monthly payment's going to look like, or the things that are going to be included in that monthly payment. It's just to give you a general idea. Okay, so again, don't place too much faith in this, because especially if you're not going under contract for another month, 2 months, 3 months, these rates are going to change. The fees will stay generally the same, but the interest rate is likely to change when you're presented with a fee sheet. Again, this is a general idea. All right, now we're going to take a look at two loan estimates. These are official loan estimates, one more official than the other, and I'm going to tell you how to spot out the differences. Okay, so this actually is from a client that I had, and they were purchasing a home, and I'm going to tell you how they chose to use funds and use money that they were getting from the seller, and how that might apply to your particular situation. Now, the format here, while on a fee sheet, is not really standardized, the format here is extremely standardized, okay? And this is probably the best way to compare apples to apples when you're looking at two different lenders. So you might be comparing here, or you can use this video just to understand what exactly is going on here and what these numbers actually mean. So I'll start with the top. Now we blurred out the client's individual information. The loan estimate on the right is the loan estimate that I provided the client. I was brokering this loan through United Wholesale Mortgage. The loan estimate they received on the left was a loan estimate that they received from another lender. And so I'm going to teach you how to compare these two things. So up in the upper right hand corner, you're going to see the loan term, what type of loan it's for, if it's for a purchase or a refi. You're going to see what type of loan it is. If it's a non-QM loan or something like that, likely the conventional block will be checked. But this loan was a VA loan. And then you're going to see whether it's locked or not. Okay, that is extremely important. And I'll dig into that here deeper here. Whether your loan estimate is locked or not is extremely critical, and you need to pay attention to this. All right. So if that loan estimate does not have that box checked that says locked, that means that you are not locked into that rate. Is that good or bad? No, it's not good or bad, but you need to understand what you're being presented with. If you've made an agreement with your loan officer to float your rate, as in not lock your rate for whatever reason, maybe you're closing for a long time in the future, or maybe you believe the market's going to get better and you're willing to risk that, that box should be not checked. But if that box is checked, you're locked into that rate, and that's as bad generally as your rate can get. All right. So you want to make sure, if you believe you're locked, or if you're putting faith in this loan estimate, you want to make sure that that check mark says locked. Okay. Now you see for this particular buyer on the right hand side, you see the loan estimate that I provided the buyer is locked. Okay. They're locked into that rate. The loan estimate that this other lender provided to the buyer is not locked. Okay. And this was something I pointed out to them. Now, they quoted them a rate where I knew that rates had gotten significantly worse the last 2 days since they provided me this loan estimate. I just happened to get lucky and locked the buyer. And on this particular deal, we won the deal because I happened to lock the rate. And this other lender was providing them an estimate that, basically they did not lock. And when he went back and called that person back, he's like, yeah, that's not available anymore. So that's something you want to make sure you're looking at when you're comparing lenders. Yeah, you might see a lower interest rate, but if the rate is not locked in, it's not valid. Okay, so you can see the monthly payments there. You see the monthly principal and interest payment. Then you get to whether if you're paying mortgage insurance, or whether you're paying escrows, or you're into the loan. This buyer was not paying escrows into the loan. I won't get into the details on why, but they were not paying escrows into the loan. This section right here, I like to call attention to because it's kind of confusing to people. It says estimated taxes and insurance. So you can look at the difference there. Sometimes people think that number, and if you look at my loan estimate, it says $1,517. Sometimes people believe that that's an addition to the monthly payment. It's not. Okay. The way these things are laid out, the government requires us to break this out in a certain way. So that's what your property taxes and homeowner insurance actually are. It's there, but it's not being added into the loan. And you may say, hey, why is the other loan estimate say $2 or something like that? I don't know. I didn't put that loan estimate together. But the reality is the taxes and insurance are actually $1,517. When you add them together. And that's why it's listed there. It's not in addition to the monthly payment. Usually you will see that number also in the estimated escrow section. Usually that number is added there also, so you know that you're paying that amount, but you're not double paying it, okay? And then you get into estimated closing costs. It estimates what your closing costs are, and I'll go through those here in a second so you have clarity on it. And then your estimated cash to close. Now this buyer, because they were getting so much money from the seller, that's why you see an amount of money being returned to them. because they were getting so much money given to them by the seller. They're getting that money back. Your money, your amount on your loan estimate may be positive or negative. The negative number is there in this situation because they're getting that money returned back to them, on a VA loan. Okay, now let's get deeper into the meat and potatoes of a loan estimate. Page 2 is where you really find the details of what's going on. You might be sitting at your local barbecue or family get together, and somebody says, well, I got a 6.1% interest rate. Somebody said, well, I got a 6.7% interest rate. The question becomes, did you get that rate for free or did you pay for that interest rate? Now, I will tell you that based on the loan estimate I'm sharing with you in this video, at the time of the market, the 4.99 that the buyer received is significantly below the average interest rate right now. And I'm going to show you why they got that interest rate that's significantly below the market rate. Their realtor did a great job of negotiating for them. Shout out to Beverly Wooten. She did a great job negotiating with the seller and with the seller's agent to get the buyer what they needed in order for the numbers to make sense on this particular property. So they did a fantastic job negotiating. Therefore, we had a lot of money to apply in different ways. This buyer decided that they wanted to buy down their interest rate or use that money to buy down the interest rate. So you see in section A, you see origination charges. All right. Now, there's 3 things that that the lender actually controls when it comes to a loan estimate. The first one is section A fees. So you're taking a look at origination fees, points that's being paid. That's what you want to take a look at. All right. How much points is being paid? So this buyer in this particular situation wanted to use a lot of money to buy down the rate. So you see the 2 comparison of the loan estimates here. Both of us are using $8,000 to buy down the rate. And you see an underwriting fee there. There's an underwriting fee being charged by the lender. That's there. Now, whenever you see section A fees, I immediately want you to take your eyes over to section J, because the question becomes, am I paying origination? And am I getting any lender credits for that origination? Sometimes you might see a loan estimate where you're getting charged $6,000 or something like that in origination. But the loan officer could structure the deal as though you're getting lender credits for that origination. So if you're paying $6,000 in section A fees, but you're getting a lender credit in section J for that $6,000, it's really offsetting that $6,000. So it's not like you're paying it. It's being charged to you, but it's also being credited to you. Also, basically, you're left with the rest of your closing costs. That's something for you to keep an eye on. So then you have your section A fees. You have your section A fees that's going to tell you, what origination charges are being, what origination is being charged for your particular situation. Then you get into section B fees. Now, it's important to tell you on your loan estimate that everything that's a part of the transaction must be disclosed to you, whether you are actually paying for that or not. For example, on a VA loan, we pay for the appraisal on all VA loans. In fact, over the last 3 years, I have personally given $200,000, over $200,000 back to veterans who are buying homes by just paying for their appraisal. It's something we do to say thank you for your service on all VA loans. All right. So we pay for the appraisal. However, when you get your initial loan estimate at the beginning of the loan process, once you're under contract, you're going to see the appraisal fee charged there. Why? It's not because you're charging it. It's not because you're being charged for it. It's just because it has to be disclosed to you, whether you're actually paying for it or not. Another thing that might happen is you might get negotiated where the seller pays for the title fees. So if the seller's paying the title fees, no matter what, in your initial loan estimate, you're going to see the title fee premium for lender's coverage is going to be listed there because it is a fee that must be disclosed to you. Now, when you go through the loan process, and this is also why when you get your loan estimate, typically the fees on your loan estimate, the amount on your loan estimate is typically higher. Your cash to close is typically higher than it actually will be. okay? Because we're required to overestimate fees and things like that. All right, so you get into a bunch of other fees, and most of these fees are standard. Your lender cannot control them. They are title fees, especially when you get into Section C. Those are title fees that the lender does not control, okay? So sometimes I'll have a buyer say to me, hey, Major, your fees are too high. And I'm like, well, it's not my fees. It's just the loan fees. It's just part of the process. The only fees that really the lender controls are the fees that are in Section A, and those may or may not be offset by a lender credit that is in Section J. So that's the two places I want you to look. All right, so you go on here. E is going to show you your taxes and other government fees. Section F is going to be your prepaids, okay, on your property taxes and your insurance. These are prepaid. So when you close on your home, there's a certain amount of fees or a certain amount of property taxes that have to be collected up front, okay? There's a certain amount of prepaid interest that has to be collected up front, okay? If you want the interest or prepaid interest to be lower, you close at the end of the month. If you want more details on that, go watch my video. That is 5 creative ways to reduce your closing costs. You can take a look at that video. I go deeper into that, okay? Initial escrow payments collected at closing. Now, this buyer is exempt from property taxes, so he didn't have Section G in there, and he paid his homeowner's insurance outside of escrow, which he has the ability to do. When you're working with us, you can structure your loan that way. He wanted to pay it outside. However, he didn't have property taxes. Now, in your Section G fees, if you're not exempt from property taxes, or if you're not exempt from, or if you don't pay your insurance outside of escrow, all right, you could have a sizable amount being added to your closing cost just because of property taxes, okay? I've said over and over again, August, September, October, those are pretty much the worst time to buy a new build because you are going to, sometimes the lender will collect for 12, 13 months of property taxes, okay? And that's going to drive up your closing costs. If you're not working with a loan officer who knows how to structure your deal to make sure you don't pay that large amount, you could end up easily getting, in Texas, $9,000, $10,000 getting added to your closing costs just because of the amount of property taxes, especially if you're buying a new build, all right? Then you get into the summary of those things. You get into lender credits, okay? I've talked about that. And then you get into the bottom here of calculating your cash to close, all right? Now, I want to call your attention to a couple of things. Closing costs financed, okay? If you're doing an FHA loan or a VA loan where you have to pay a funding fee, you can finance the funding fee into your loan. So this buyer particularly did not have a funding fee because he was exempt from the funding fee on his VA loan. However, if you do have a funding fee on an FHA, USDA, or VA loan, that can be financed into your loan. You're also going to see down payment funds. If you're paying a down payment, it's going to be listed there. Deposit, if you put any deposit, up front, it's going to subtract that deposit amount from your calculation of the cash to close. Any seller credits is going to be listed there. And then it's going to give you a total of your estimated cash to close. And that number on your estimated cash to close is the same as the number on the bottom of page 1 of your loan estimate. That's going to give you those two numbers do and always match. Okay. When you get into page 3 here, you get into a lot of government disclosure numbers that I don't put a lot of weight into. Some people like to read the APR. I'll do another video why I think APR is not a valid estimate at all. Number one is calculated over the course of 30 years. I've done a lot of mortgages, and I have had exactly one buyer who has had their home for 27 years and still had a mortgage on it, and did not refinance one single time. Okay. Likely every consumer is going to refinance on the far end every 5 to 7 years. So even to measure a mortgage over 30 years, I think is, kind of misleading. Now, if you're comparing lenders or if you're looking at numbers, then you have to ask yourself a question. Is the numbers all that really matter? And some people that are really black and white say yes. I disagree with that. Here's some other questions that you have to ask yourself when you're comparing lenders, or if you're looking at a fee sheet, or if you're looking at a loan estimate or something like that. Are the numbers all that really matter? I would say no, it is not all that really matter. I have seen people really mess up their transaction and really mess up their home buying process because they only make a decision based on numbers. And here's some other questions that you should ask yourself. Question number one, who do I trust? Who do I actually trust to help me and my family get into this home? Or am I going to trust the person who I can call up and ask questions and get situations resolved? Or am I going to trust the, call center loan officer who I can't get a hold of, except between 8 and 5, and he or she doesn't answer my questions, or they're giving me this bottom rate, a bottom interest rate, and I don't know whether they really actually understand my life situation or understand the loan program, but they're throwing this low interest rate at me, and they're selling the rate, but I'm not getting anything to go along with that rate, and I need a lot of guidance and stuff like that. Of course, that changes as you're buying your fourth, fifth home. If you're buying your fourth or fifth home, yeah, maybe you can work with the call center loan officer or online loan officer or something like that because you understand the process, you understand the numbers. If you're a first-time home buyer or second-time home buyer and you need a lot of hand-holding, you need to ask yourself the question, who do I actually trust to walk me through this process? Number two, who do I have time invested with? Okay. I've seen so many times, and I have people call me and say, "Hey, Major, can you give me a comparison, or can you give me some information on where rates actually are? I'm getting a quote here, and I want to know like where rates actually stand." And I will ask them like, "Okay, if you already have a quote, tell me about your relationship with that other loan officer. Have they, worked with you to get your credit score up? Have they been walking with you through this process for a year or something like that?" I don't like when people do that to me, so I try not to do that to other people. So, I want to ask those questions, and those are some things that you should consider. What's the effort that's been put in by the other loan officer? I will tell you that credit pulls alone are extremely expensive. Now, you may be somebody who says, "I don't care, that's just the cost of doing business. I'm going to do what's best for me," and I guess that's fine, but I like to be more respectful of people. So, if somebody's put in a lot of effort, pull credit, which costs them money up front because the loan officer is not paid until you actually close on a loan, I would ask myself the question of who's actually put in the work, who's put in the effort, who's helped me get my credit score up, who's coached me through this, coached me through a transition in life, been working with me repeatedly. I would want to know those questions before I make a selection, just based on, my closing cost here is $75 less than my closing cost over here. Or, the interest rate over here is 0.02% lower than the interest percent over here. That's a question that I recommend you ask yourself also. Now, if you're comparing interest rates and somebody's at a 7.2 and somebody else is at a 6.2, look, that's kind of off the market. But I would actually go back to that loan officer and I'm like, "Hey, I'm being quoted this. You're telling me this. Tell me why there's such a disparity here, in the interest rate." That's another question I would recommend you consider. Question number 3, do I have a unique underwriting situation? Okay. A low interest rate on a loan that somebody can't close is useless. If you have a unique underwriting situation, you have a unique income situation, and this person has already worked with the loan officer, already worked with an underwriter to get approval and figure out this, underwriting situation or this funky situation that you have going on. And now you want to up and go to a different loan officer. I've had this happen to me before. I've gotten loan approval on a situation and somebody says, "Oh, this person's offering me this interest rate." They go over there to try to get that interest rate. That loan officer didn't understand the uniqueness of the, situation, the uniqueness of the income, the uniqueness of the, maybe it's a unique employment situation or a unique documentation situation. Maybe you're new to the US or something like that. And we have a unique visa situation and we have to figure this out. Those are situations that the loan officer probably has already reviewed with an underwriter to say, "Hey, we need to do X, Y, and Z, and this is the loan type we need to do in order to get this done." And I've had people leave me, go to another loan officer. When you leave, I cancel your loan because you say you're not going to work with me and my team. And then they come back, and by the time they come back, the interest rate has gone up and the situation is totally different, and it ended up costing them more money because they just didn't understand what was at stake when they shifted loan officers. So this is another situation you have to consider. Do I have a unique underwriting situation that I need to get through underwriting, and I know that this person has already figured this out, and I'm working with them because they've already figured out the situation? Finally, the last question I would recommend you ask is, will this delay my closing? If it delays your closing, then the seller could potentially back out of the contract because you decided to play around with your financing, okay? So that's another question that you have to ask yourself. If I switch lenders, or if I change over to this lender at this point in the process, is this going to change my financing situation, or am I going to have an issue with getting closed if I, shift over? And this is a conversation that you frankly should have with your realtor. Do you have time to shift? The realtor should probably call the loan officer. If you got 2 to 3 weeks, frankly, and you're talking to me and my team, you're probably going to be okay. If you got like 6 days, even legally, you can't close a loan that fast because you technically have to have 7, depending on how you measure it, 7 to 8 days if you're doing a loan to legally and compliantly go from, signing of initial disclosures to closing. You actually have to have a certain amount of days in there to legally hit all the wickets. So, if you're shifting at 4 or 5 days, left under contract, you're going to have a problem. Okay. So you need to talk to your realtor about that and say, hey, I'm getting this. I think it's going to save me a lot of money. Talk with your realtor and figure out if you actually have time to shift lenders. Okay. Now, whether you're working with me and my team or not, I do hope that this added some value to you, added some value to your home buying process, and really cleared up some confusion that you might have in the buying process. So it helps you understand what is a valid document and was not a valid document, and helps you understand loan estimates and fee sheets a little bit better. Thanks for joining me on this episode of Major Money Matters. See you next time.